The last several days have been volatile, to say the least, for markets, as investors digest the latest on tariffs, trade tensions, and what it all means for the global economy, and perhaps a reordering of the global order. And that is also true for oil and other commodities, as investors worry about the outlook for demand. Here to break down what these uncertainties all mean for commodities and the complex is Hussein Allidina. He is Managing Director and Head of Commodities at TD Asset Management. Thanks so much for making the time. I know you're busy.
Thanks for having me.
Let's start with, just to let people, I want to talk about, oil, copper, gold, silver, find out what's happening. But I want to, take it up a level first and talk about the importance of a balanced portfolio in this kind of environment. This is the time it shows up.
Yeah, so we've talked before about the correlation between 60-40. 60-40 was the optimal portfolio for a very long time while inflation was contained, and you had that negative correlation between the two. Historically, folks have looked at commodity derivatives as part of their asset mix, or the folks that have looked at commodities as part of their asset mix have done so because of the negative correlation it provides. Commodities have definitely been caught up in the last sort of 10 days in this sort of market retracement. But if we look year to date, commodities, the Bloomberg Commodity Index was down, 1.5% as of this morning, versus equities down 17% and fixed income doing what it does. In the environment where you have stagflation, which folks are talking more about today, unfortunately, commodities are one of the few assets that perform well. Now, most folks will agree and admit that they're not smart enough to call the macro environment that we're going to head into tomorrow. There's a lot of uncertainty around that. So you want to build a balanced portfolio that includes things like infrastructure, real estate, and commodities. Commodities are that hedge against inflation, the hedge against stagflation. And I think, for the better part of the last 10, 15 years, we haven't needed that diversification. It's been relatively easy in that sort of 60-40 portfolio. I'm not sure the environment going forward is going to be as conducive. And I think it does increase the demand for those diversifying assets.
Yeah. Okay. Good thing to keep in mind as we watch what we watch. Let's talk about some of the individual commodities. Oil. I think before President Trump came into power, was trading in around, I think, 73. I think now, again, day by day, minute by minute, what's happening. I think we're in around 55 for WTI. Why are we seeing that priced into oil right now? What is getting priced in? And do you think, the market's always right, but what do you see maybe people should consider in terms of where it's going?
So maybe before we even do oil specifically, I think what's happening in risk markets broadly is we're trying to reprice growth. Right. What is demand growth going to look like, right? We thought originally oil demand in 2025 would grow by 1.2 million barrels a day. There's a tremendous amount of uncertainty around what the level of GDP globally is going to look like on the heels of this sort of trade war that's unfolding. If global demand doesn't grow by 1.2 million barrels a day and grows by 500,000 barrels a day, or doesn't grow at all, then we see kind of the supply-demand imbalance this year and inventories building. Now, I think it's important to appreciate that inventories are tight today. The structure of the market is telling you that inventories are tight. Refinery margins are still very positive. So we're not seeing that demand capitulation today. There is some anticipation being priced in. And I think why oil has underperformed copper, soybeans, coffee, et cetera, is because at the same time that we're repricing growth on the demand side, OPEC is adding barrels to the market. And again, I think when you look at the headlines, OPEC bringing back 3 months of production in May versus doing it gradually over the course of the year, that looks bearish. We're not necessarily accounting for the fact that Venezuelan production is off the market since the start of the year. We're not discounting necessarily the barrels that we may lose from Iran if sanctions are enforced. Deer in the headlights, right? I see my demand numbers falling because of the trade war, and I see supply on the margin increasing near term. We can talk about the medium term and what today's weak price means for that. And ultimately, it's difficult to be long oil. And I think that's why you're seeing the weakness you are. If you ask me about the medium term or what this sort of weakness in price and the volatility in price does to the supply side, it's a challenge. Drill, baby drill, we've talked about this before, it doesn't work at $60 a barrel, $65 a barrel. No. It doesn't work at 55. It works less at 55. If you look at oil companies across the world, you're going to get into an environment where they're going to have to cut CapEx and or share buybacks and or dividends because today's price doesn't work. So again, we're not thinking about that today. We're worried about demand today. But when we look further out, this volatility and this weakness in price is going to create, I think, deficits into the future, which will be a concern.
I think it's interesting that at what point, and this is almost this question for commodities especially, but almost for everything, is what point does the problems we're having right now, the tariff wars, between China and the United States, start to hit? You talk about supply destruction, and how long? I mean, can you give me a sense of if this lasts for a week, then lower impact. If this lasts for a year, incredibly high impact. So how do you gauge that?
Yeah, so this is why you kind of have that very pronounced commodity cycle, right? You've got these periods where commodity prices trade well above their cost of production, and you've got longer periods of time where commodities trade below their cost of production. If I'm an oil producer today or a copper producer, especially a copper producer, all of my cost is already sunk, right? So if I look, for example, at the copper supply growth that is expected in 2025, 2026, and 2027, that's all coming from projects that started in 2012, right? They're not going to slow or stop those projects, right? The cash cost of production as a percentage of your total cost is very low. So there is inelasticity in supply. So when demand does capitulate, you'll see a response arguably first on the demand side with prices coming lower, encouraging demand, before you see a response on the supply side. Now, oil maybe is slightly different because some of our production growth comes from shale production, which is shorter cycle. So if you had thought U.S. production was going to grow by 500,000 or 600,000 barrels a day this year, that number has been pared meaningfully down to maybe 100,000, 200,000 barrels a day, and going lower if prices stay at these levels. The supply side is relatively inelastic, which lends to extended periods of time where the price of the commodity can trade below its replacement cost. And that's, I think, what we're battling today.
Yeah. So I've heard one scenario, I'll say the most optimistic scenario, and I'm not saying that I'm going to say what I think the probability of this is that tariff war happens, trade deals get done, and then the U.S. government decides, okay, let's start on our stimulus and cutting regulation and starting to stimulate things and getting things going. If that scenario plays out, where do you see oil and copper?
Yeah, so once we get through this trade drama, let's call it, we can then focus on what the second derivative for growth is going to look like. Right now, the second derivative is very negative because we're trying to price in what 100% tariffs mean between China, the US, the rest of the world, et cetera. But ultimately, if we rewind to just March, right, we saw Europe announce sort of massive fiscal spend as it relates to defense. We've seen China increasing their fiscal spend. There's a lot of spend being done that is commodity intensive, and deglobalization is definitely bullish to the commodity because we're going to move from just in time to just in case. We're going to have duplicative supply chains, which are all very sort of commodity intensive. But I have to get through this window where I'm extremely concerned about what growth is going to look like in the near term.
Yeah. We want to talk a bit about gold. I'd say just in the past maybe few days, year to date, it's wildly outperformed everything else, basically.
Yeah, and if we go back to what we started with, right, like portfolio construction, the reason you want to hold gold in your portfolio is because in the tails of the distribution, when things get really hairy, and I'd argue that...
And when you say tails of distribution, you mean these events that don't happen that often?
Massive risk on, massive risk off, a ton of inflation, a ton of deflation, gold tends to perform well.
Yeah.
There's definitely days, weeks where I'm going to reach for my gold to fund something that isn't working.
Yeah, which is what we probably have seen.
We've seen that, I think, on occasion since sort of April 2nd for sure. But if we look at the fundamentals of gold, you are seeing, I think, structural buying of gold, particularly from EM central banks. We've talked about this over the course of the last 2 years.
Explain it out a bit, though.
So if I look at the reserves, central bank reserves of Germany or Italy or France, north of 70% of their total reserves sit in gold. If I look at the reserves of China, India, Russia, Turkey, Poland, right, the list goes on, Malaysia, Indonesia, the bulk of their reserves sit in fiat currency, in US dollars. In US dollars that can be confiscated whenever...
politicized.
Whenever they want. And so what we've seen over the course of the last 16 months, and I think it started in earnest when the U.S. confiscated Afghan reserves after the Taliban took Afghanistan back. And then it happened in a more pronounced way when we confiscated, or when the U.S. confiscated Russian reserves. You've seen on the margin buying of gold from EM central banks. That's been a very meaningful source of demand for the gold market, but it hasn't really made a difference in their aggregate reserves. So our view has been that you will continue to see this portfolio diversification from EM central banks, not necessarily because of de-dollarization, but because of better portfolio construction. We had data that came out yesterday. China has been buying a remarkable amount of gold, but it's not just China. So I think this is important. Like, you will see volatility in the gold price, but structurally, I don't think, particularly with what's going on today, that the marginal demand, I think, for gold is going to come from these central banks and will continue to come from central banks. What we have seen in the last quarter is interest in gold from retail and institutional. And we've talked about this before, but the opportunity cost of holding gold, which doesn't pay a dividend, is not a cash flowing asset, is where else I can put my money. Over the course of 2024, 2025, early part of 25, equities were performing, right? By buying gold, I'm giving up potentially 20% upside in equities. I think the volatility in the market is encouraging, I think, better sort of portfolio construction globally, and that is a tailwind for gold. What we're seeing in the dollar, what we're seeing in treasuries is a concern again, and I think on the margin, gold isn't something that I can manipulate, right? And I think that's why we're seeing the interest in the asset class.
Yeah, I think, I want to make sure we touch on silver just because, some people kind of look at silver thinking that it is a pseudo gold. Because it's also an industrial metal. So it actually, as you said, it's attached to GDP because its demand is attached to that.
So if I look across, again, commodities have beta to inflation. So if I'm trying to hedge inflation, I want to own commodities because commodities tend to be a source of inflation. Gold has a lot of beta to inflation, and that's why it does well in the tails of the distribution. But commodities also have beta to growth. So we talked about oil and why oil is suffering and why aluminum is down and why nickel is down. It's because we're recalibrating our growth expectations. Silver has more beta to growth than gold. So it is not surprising to see gold performing better than silver. Now, silver's up today, and silver's been up on many days over the course of the last 10, 12 when growth assets have been sold. But I still have that beta to growth, and I don't know what growth is going to look like a month from now, 3 months from now. And silver arguably underperforms if we remain concerned about growth. When I see growth expectations, the second derivative on growth getting better, I expect silver to outperform gold because of that link to GDP.
I've only got about a minute left, and I want to ask you. I know I've over the years joked if you're concerned about inflation, stagflation, buy the periodic table. That's kind of the way to do things. But thoughts on stagflation, probability?
It's concerning, right? Tariffs are inflationary, and the magnitude of tariffs that we're seeing and the back and forth is pointing to even more inflation. And they're not great for growth in the short run, for sure. If we look historically at assets that have performed in stagflationary environments, in that quadrant where growth is low and inflation is high, the reason institutional investors, pensions, superannuations have held this allocation to commodities through time is because they concur that they're not smart enough to know when we're going to move into that quadrant. And in that quadrant, there's very few things that work outside of commodities.